Right. Say $100,000 lands in your account tomorrow. Redundancy payout, inheritance, sold the house, doesn't matter how, it's there. What you do with it in the next 12 months could genuinely be the difference between knocking off at 55 or still dragging yourself into work at 70. Chuck it into the share market and let compounding do the heavy lifting. Or use it as a deposit, borrow the bank's money and let leverage do the work instead. This is the debate every Aussie with cash sitting idle has with themselves at 1 a.m, scrolling property listings in one tab and the ASX in the other. Today we're doing the actual maths, using real 2026 numbers, not vibes, not my mate reckons, not some guru's cherry-picked chart. G'day, welcome back. We're settling the great Aussie money stoosh, shares versus property, with $100,000 as our test case. Stick around because there's a twist near the end that most finance channels conveniently leave out, and it changes the whole equation. By the time we're done, you'll know which option actually suits your situation, not just which one sounds better in a headline. Let's start with shares, because most people undersell how strong this option actually is. Drop $100,000 into an ASX 200 index fund today, something like VOIS or A200, and history says you're looking at roughly 9% a year on average once you include dividends reinvested through booms, crashes, the lot. Right now, the ASX 200's average dividend yield sits around 3.5% in cash terms. And because Aussie companies have already paid tax on those profits, a big chunk comes fully franked. Once you gross that up with franking credits, your effective yield on the income side alone can push toward 4 to 4.5%. That's the quiet superpower of investing locally instead of chasing the US market. The tax office is basically topping up your return every year. No extra effort required. So the numbers, $100,000 compounding at 9% for 10 years lands you around $236,000. Stretch it to 20 years and you're sitting on roughly $560,000. No mortgage broker, no tenant ringing you at midnight because the hot water system's carked it. No 6 monthly building inspection. You buy the fund, you leave it alone. Compounding does the rest while you're at work, asleep, or on holidays in Bali. Here's the bit people skip. You don't have to stop at $100,000. Drip feed an extra $500 a month into that same fund, and after 20 years at 9%, you're not looking at $560,000. You're looking at north of $900,000. Dollar cost averaging smooths out the wild months, takes the emotion out of it, and turns wealth building into something boring on purpose. And that's really the point. The best investing strategy is usually the one that's dull enough that you actually stick with it for 2 decades straight. But here's where property investors have an advantage shareholders simply don't get. And it flips this whole debate on its head. With $100,000, you don't buy a $100,000 property. You use it as a deposit and control something worth $500,000. The bank stumps up the rest, so your $100,000 isn't growing on its own. It's growing on the full $500,000, whether you're the one who saved it or not. Now, the national median dwelling value sits around $920,000 in 2026, with Sydney and Melbourne actually easing back from their late 2025 highs, while Perth, Adelaide and Brisbane keep climbing. So a $500,000 entry point today generally means a growth corridor. Outer Ring Brisbane, regional Queensland, parts of Adelaide or Perth. Not a capital city house on a quarter-acre block. That's not a downgrade, that's just where the math still works. For a first-time investor, with this kind of deposit, property has historically grown around 6% a year on average, which sounds tame next to shares. But that 6% isn't landing on your $100,000. It's landing on the full $500,000. A 6% bump in year one adds $30,000 to your net worth off a $100,000 outlay. That's a 30% return on your actual cash. That's leverage doing what it does, and it's the exact reason property investors talk about growth percentages so differently to share investors. With rental vacancy rates sitting near record lows around 1.5% and rents up nearly 6% over the past year, a $500,000 investment property in a solid corridor could realistically pull in $18,000 to $22,000 a year in rent. Subtract mortgage repayments, and with the RBA cash rate at 4.35% after 3 hikes through 2026, those repayments aren't cheap, plus insurance, council rates and property management fees, and you might run slightly cash flow negative. That's negative gearing. And here's the twist. As of the May 2026 federal budget, negative gearing rules actually changed. This isn't speculation anymore, it's law. If you buy an established property from here on, any rental losses can only be offset against rental income or future capital gains, not your salary. The old rules still apply if you already owned before budget night. And new build purchases still get the full treatment. On top of that, the 50% capital gains tax discount is being replaced with cost-based indexation and a 30% minimum tax on gains made from July 2027 onward. So the tax perks that used to make property a near automatic win for investors are being trimmed back. Worth knowing before you sign anything, and definitely worth a chat with an accountant before you commit. Even accounting for that, let's run the property numbers. A $500,000 property growing at a slightly more conservative 5.5% given current conditions is worth roughly $853,000 after 10 years. Subtract your remaining loan and your equity position still comfortably beats what shares alone would have delivered on the same $100,000. Stretch to 20 years and that same property could be worth over $1.4 million. And that's before you factor in 2 decades of rent, some of it covering the mortgage the whole way through. Quick one before we keep going. Drop a comment below and tell me, are you team shares or team property? I'll pin my favourite answer. Now, before you go all in on leverage, there's a catch almost nobody factors in properly. Buying that $500,000 property doesn't just cost your deposit. Stamp duty alone can run $18,000 to $25,000 depending on the state. Add conveyancing, building and pest inspections, loan establishment fees, and potentially lender's mortgage insurance if you're under 20% deposit. And you can burn through $25,000 to $30,000 of your $100,000 before you even get the keys. Shares cost you almost nothing to buy. Most platforms charge next to no brokerage these days, and you can literally be invested within minutes of transferring the money. So it's not really shares versus property. They're different tools for different jobs. Shares give you liquidity. Sell $5,000 worth on a Tuesday. Have the cash in your account by Thursday. Property gives you forced savings through the mortgage and leverage you simply can't replicate with a share portfolio. Short of borrowing to invest, which brings its own risks. Shares diversify you across 200 companies with one purchase. Banks, miners, retailers, healthcare, tech, all in one trade. Property concentrates your risk into one asset, in one suburb, in one local market. But it gives you something shares never will. Control. You can renovate, add a granny flat, re-tenant at a higher rent, force the value up yourself through sheer effort. With an index fund, you're a very well-rewarded passenger. With property, you're the one behind the wheel. And don't ignore the psychology, because it matters more than most people admit. A mortgage forces discipline. You can't panic sell a house at 2 a.m. because the market wobbled overnight. There's no app for that. Shares don't have that guardrail, and behavioural finance research consistently shows the average investor underperforms their own portfolio simply because they sell at the worst possible moment and buy back in too late. Sometimes the better investment on paper isn't the one that wins in real life. It's the one you'll actually hold on to long enough to let it do its job. So here's the honest answer to the $100,000 question. If you want simplicity and rock-solid long-term compounding, shares are seriously hard to beat. Drop it into a diversified index fund, reinvest the dividends, enjoy the franking credits, and let time do the heavy lifting. If you're ready to use other people's money to accelerate things and you can handle the costs, the new tax rules, and the risk that comes with leverage, property can still deliver returns. Shares mathematically can't match off the same starting capital. But the real wealth builders in this country don't pick a side and stop there. They build a share portfolio for liquidity and compounding, and they use leverage to grow a property portfolio alongside it, letting each one cover the other's weak spot. That's how generational wealth actually gets built here. Quietly, over decades, not overnight. If this helped you think about your $100,000 differently, smash that like button and subscribe for more no-fluff Aussie finance breakdowns. Thanks for watching. I'll see you in the next one.